This is Andrew Stotz, and I'm going to be talking about my Uncovered Asia series. If you have any questions as I go through this, feel free to ask. So, my first question to you is, how does a company create value after a hostile takeover attempt? My name is Andrew Stotz, and welcome to Uncovered Asia, where I explore interesting stocks in Asia that few institutions and analysts cover. This is Uncovered Asia. Today's company is China Glass Holding, CNG. Now, before I go into this, I just want to make sure that you know this is not an investment advice. This is information. This company is government-backed. It's a glass producer, and it became an acquisition target. CNG has 13 float glass production lines with a daily capacity of 6,650 tons a day. Market share is 0.4% of the global glass manufacturing market. 20% of revenue is generated abroad. That's Nigeria, that's the Middle East, that's Bangladesh, that's Italy, and that's the Philippines. And there's three things that I want you to know about this company that I want you to think about. First, hostile takeover approach by top competitor Xinyi Glass ended unsuccessfully. Second, continued increasing glass demand in Asia is driving revenue growth prospects. And number three, acquisition of Fujian Longtai Jiahao helps to expand its energy-saving glass production. Let's get into it. This company's product and revenue contributions, 44% is what's called clear glass. That's glass used for real estate and automotive windows. Another 25% is coated glass, which is for office building windows. And then 14% is painted glass for home and personal usage. And then you've got 12% for energy saving glass, and installation service is the rest. So this is a glass company. If you're interested in glass companies, well, what is it drives glass companies? Production of cars, production of manufacturing of houses, buildings, all of that. Now, here is the revenue. The revenue surged by 35% year on year. If you look at 2019, you can actually see revenue fell, but now revenue has risen. 23% is attributable to an increase in volume, and 10% is attributable to an increase in price. Now, let's get into the point number one. The hostile takeover approach by top competitor Xinyi Glass ended unsuccessfully. In December 2020, Xinyi Glass planned to acquire all of CNG's outstanding shares for $212 million. As you can see, this is like a small cap company when you look at, let's say, China or other markets. The tender offer to the shareholders was at a 17.4% discount to the market price. In February 2021, the acquisition approach failed as the offer expired and the shareholders did not take it up. Now, it's important, normally, if a company wants to buy another company, they don't go at them with a significant discount to the market. They usually go at them with a premium to the market because they could buy the shares in the market and try to accumulate shares to control the company. Or in other cases, what they could do is say, we want to buy the shares from you. We're willing to pay a premium, and let's get all of you guys to sell your shares. So CNG puts defense mechanisms in place. In May 2021, CNG has proposed a share buyback to its shareholders, and this move is part of a defense mechanism to protect against further takeovers. Number two, continued increasing glass demand in Asia is driving revenue growth prospects. The Asia-Pacific glass market is projected to grow at 3% over the next 5 years. The main driver of glass market growth is the increasing housing construction activities in Asia-Pacific emerging economies. Now, the third point is the acquisition of Fujian Longtai Jiahao, which helps to expand its energy-saving glass production. Both parties agreed to an acquisition price of $40 million for 55% of the outstanding shares. The acquisition allows CNG to increase its production capacity for energy-saving glass, which is what Fujian Longtai Jiahao does. The market reacted positively to the announcement with a significant surge in share price. And there it is. You can see that there's been strong momentum recently. But look at that share price. The share price still is only back where the previous highs were. And now they've made this acquisition. So if we look at it over a 12-month period, yes, the share price is up 180%. But just over the 3 months, it's up about, let's say, 13%. So now the question that we have to ask is, when we see a share price shoot up like that, should we just forget it? It's already run, or should we consider that maybe this is a stock that we should do some research on? In order to answer that question, I use our tool, which is called FVMR Scorecard. It considers a stock's investment attractiveness relative to stocks in that country or region. Attractiveness is based on our 4 elements: fundamentals, valuation, momentum, and risk. That's FVMR. And it considers a company over 5 years, and the scale is from 1 to 10, 1 being best. So let's take a look. What do we see? Fundamentals, middle of the road. We can see the yellow box in the bar at the top left, and it's middle of the road. What we look at is valuation. It's a little bit above average. And in fact, look at how cheap that company is. It's 0.8 times price to book and a price to sales of 0.5 times. Now, where the company really is making headway and looks attractive is in momentum, both momentum in revenue growth and momentum in share price. So if we look at all of that combined, I would say that the company looks reasonably attractive. But let's look at it from another angle. Let's use our world-class benchmarking scorecard, which helps identify a company's competitive position relative to global peers. Combined composite rank of profitability and growth, which we call profitable growth. It considers a company over 5 years, and the scale is from 1 to 10, with 1 being the best. Let's take a look at what we find here. And what we find is a ranking of a 9, 9, 1, 10, 9. What that means is that it's pretty bad. Now, there is some hope here. If you see the PTM, the past 12 months, it shows that the company's score has gone from 10 to 9. So it is improved by 1 mark. And this is benchmarked against 1,310 medium-sized industrial companies worldwide. And if we go down a little bit deeper, we can see that profitability has maintained its ranking at a 9, but growth is starting to move. We can see growth has gone from 10 to 7, and that is the recovery or the fast growth that's happening in the revenue right now. And that could potentially be a driver for further earnings, and therefore maybe the stock is not that expensive. So what are the risk factors? Fluctuation of raw material prices, increased petroleum coke prices, foreign exchange risks, a slowdown in gas-dependent industries, and environmental regulations. So let's go back to the beginning. There's 3 things you should know about this company. Hostile takeover approach by top competitor Xinyi Glass ended unsuccessfully. Number 2, continued increasing glass demand in Asia is driving revenue growth prospects. And number 3, acquisition of Fujian Longtai Jiahao helps to expand its energy savings glass production. So I have a question for you. How does a company create value after a hostile takeover attempt? If you want to know how I pick stocks, just download my stock picking checklist for free by scanning that QR code. Now, if there's any questions, I'm happy to take them. In fact, I do see a question there, and let's see. Hold on. I'm going to get rid of this screen. There we are. All right. Any questions? Suchai says, what could be some reasons that Xinyi proposed a high discount rate for the acquisition of CNG? Well, I think the first, probably it's that they were trying to buy it in the bottom of COVID crisis. So they were probably thinking they could get this company cheap, and they wanted to buy it cheap. Remember that revenue was falling in the revenue chart that we saw. So, you could argue that this company may have been at risk. So that's the first reason, is that they thought they would get it for cheap. Now, the other reason is that maybe the 17% discount that they offered was happened and then the share price really shot up. And once that share price shot up, then all of a sudden it's a problem, because then you've got the company, basically nobody's going to take the offer from the company that's being acquired because they can get a better price in the stock market. So the share price is an interesting one. Now, do you see interest rates rising soon? Yes, I think interest rates are rising now, less so in Asia, because Asia's already got relatively high interest rates. And in fact, with this company, let's just go back and look at that for just 1 second. Here we can see the bottom right-hand corner is risk, and the company's ranking is relatively low on risk, and that's part of because the net debt to equity has gone to 132. So for every 100 in equity, they have 132 of net debt. Now that's partially because of the acquisition that they've recently done, which basically puts pressure on there. So let's see if we've got any other questions. Mohammed says, not now. Okay, no questions. All right. If there aren't any other questions, I hope you enjoyed that. And if there's a stock that you would like me to look at that you think deserves to be covered in Asia, but it's actually uncovered in Asia, let me know, and I'll see you for the next stock.